Number 1. The 2% Rule. The 2% rule in real estate is a guideline that helps investors determine the property's potential rental revenue. The guideline specifies that a property's rental revenue should be at least 2% of the purchase price. For example, if a property costs $200,000, the monthly rental must be at least $4,000 to be considered a solid investment under the 2% rule. Simply multiply the property price by 0.02 to calculate the 2% guideline. For instance, if the property is worth $175,000, the minimal rental income is $3,500. The 2% rule is a quick and easy calculation for determining the possible return on investment for rental properties, but it does not account for running expenditures or debt payments. When determining rental prices for a property, the 2% rule tells you the minimum rental revenue you should aim for. It does not, however, guarantee that you'll be able to collect that amount. For example, if a $600,000 house is located in a rental market where comparable properties rent for $7,000 to $8,000 per month, expecting to receive $12,000 per month may be impractical. Other expenses such as property upgrades or marketing costs would have to be considered to increase rental income. The 2% rule is a basic guideline and falls short in various situations. For starters, the 2% rule does not consider vacancy rates. As has already been told, it excludes operating expenses and debt service, which can significantly impact a property's profitability. Also, the 2% rule does not account for costs of preparing the property for rental. This can involve repairs, renovations, and enhancements to the property that must be completed before it can be rented. Not just that, the 2% rule also excludes continuing maintenance costs and homeowners association fees, which can increase the property's expenses. Finally, remember that the 2% rule does not guarantee that a rental property will earn a profit, so it's critical to consider all aspects of a rental property investment rather than solely relying on the 2% rule. You can also opt for a thorough financial plan for your real estate investing. Also, creating objectives and goals with a financial advisor may help you in the long run. Number 2. The 50% Rule. The 50% rule in real estate is a simple and effective method for investors to determine the profitability of a rental property. It specifies that half of the property's gross income should be allocated to operating expenses, such as property taxes, insurance, repairs, and utilities. Using this technique, investors can avoid underestimating expenses and overestimating earnings. The 50% rule is simple to calculate. Divide the estimated gross rent by 2. For instance, if a property is expected to generate $3,000 in gross monthly rent, $1,500 would be set aside for running expenses, excluding mortgage payments and HOA fees. This can indicate how much money you could make if you invested in the property. We would like to remind you that the 50% rule is only a guideline and should not be considered hard and fast. The rule is meant to keep investors from underestimating the cost of owning a property. Still, it doesn't consider changes in insurance rates, property values, or rental demand. All these things add up and determine the profit. So what should you do? Well, researching the area where the property is located will give you a better idea of the costs you may pay and will allow you to make an informed decision about whether the investment suits you. While the 50% rule is only a starting point, it can give you an idea of the expenses you may incur and the cash flow you may earn. Number 3. The 70% Rule. The 70% rule is a rule of thumb in real estate investing that says that an investor shouldn't pay more than 70% of a property's after-repair value, or ARV, for it. Once you've established the cost of renovating an investment property, your maximum purchase price should not exceed 70% of the property's value when the renovations are completed. So let's put the 70% rule to work. Assume you find a property you wish to invest in and that's advertised for $150,000. Your after-repair value, ARV, would be $200,000 after hiring a contractor and considering the expected renovation cost of $50,000. Using the 70% guideline, multiply the ARV by 0.7 to get $140,000. This is the most you should spend for that property. However, following the 70% rule might take a lot of work. Estimating renovation expenditures and determining the ARV can be complicated and time-consuming. You don't want to over-renovate, but you also don't want to be priced out of the market. That is why working with a real estate agent familiar with the local market is critical. Having a licensed professional estimate the projected renovation expenses might be another workable solution. Other charges, known as carrying costs, must also be considered when investing in real estate. If you need an idea, property taxes, insurance, upkeep, and utilities are examples of carrying costs. On the other hand, Closing fees are the costs incurred while purchasing a home, such as legal fees, title search fees, and home inspection fees, while financing charges include interest and origination fees when acquiring a mortgage. Oh, and please remember to consider your selling costs. It includes charges incurred during selling, such as real estate commissions, title insurance, and transfer taxes. So carrying costs, closing fees, financing charges, and selling costs can all mount up and significantly impact the transaction's overall profitability. These expenditures can eat into an investment's profits if not adequately accounted for. The solution to all these complications is pretty simple: estimating and incorporating these expenditures into your investing strategy. It will help you make more educated and lucrative real estate investment decisions. Also, it is critical to have a contingency plan in place in case of unforeseen events, such as rapid reduction in property prices or necessary repairs. While making real estate decisions, a straightforward thing should always be kept in mind. All investments, including real estate investments, carry inherent dangers. That's all, guys. In real estate investing, the 2% rule, 50% rule, and 70% rule give a basic foundation for evaluating investment opportunities. However, it's critical to remember that they are only guidelines and should not be used to make investment decisions. A solid financial plan that accounts for all expenses, rental market conditions, and personal investment goals should all be considered for real estate investing success. So the question is, which of these rules do you find most useful and why? Let us know in the comments below. Remember to hit the like button and follow the growth mindset. Thanks for tuning in.